I caught the weekend stream last night. You mentioned yields up to 7%. What could cause the Fed to allow this in the face of both presidential candidates talking about cutting rates? I don't think they'll do it until they can politically, which would be after the election. But it's their only out from the trap that they've put themselves in. They've really backed themselves into a corner trying to support strength in the labor market versus, price stability, right? So the Fed leaned in hard at the end of 2022 into the beginning of 2023 into providing a strong labor market, right? The strong labor market would be the solution to our economic woes, but it's not, right? Most of what's made our labor market strong is people leaving it, right? And so demand in the labor market has stayed pretty elevated across the last 3 years because there's simply fewer workers. There's fewer people being born, not just right now, but over the last generation, right? Fewer people are coming into the job market, and people are leaving the job market at a greater rate than they're coming in, right? And so that's, but yet all the businesses and everything still remain in place. They still have the same labor demand. There's just fewer people to fill those positions, right? And so by doing that, they've allowed, inflation to remain volatile, right? They've really done very little to address inflation. And they definitely haven't done enough economic damage to cause corporations to stop pricing up the forward return on goods, right? And so you get margin expansion due to inflation because companies become very efficient at pricing goods up as they sell them out to the general public. The same with services, goods and services. And so, because of that, the Fed doesn't really have a handle on inflation. And so, if they cut rates, inflation will surge. If they raise rates, but don't do it enough, inflation will still stay elevated, but they'll do damage to the labor market, right? And so the only way to stop this, right, is to either you cut rates to nothing and let the banks fail, right? Banks are pushed into a position where they have to market their securities. You get the hard landing, or the alternative is you raise rates significantly above the rate of inflation and you crush the economy. But it's really hard to crush the economy when the entire GDP is being supported by deficit spending, right? If we're spending up the GDP, we're not going to use another branch of the government to simultaneously crush those returns. And so they've done nothing, and now they're in a position where they can't really do anything. They can just leave rates where they are because too much up, banks fail. Cut too much, banks fail. So the choice they go with is stagflation as long as possible, basically. Yeah. Well, I mean, like I said this at the beginning of the year, like the best path forward, right, is rates stay flat. Maybe they need to move them up a little bit at some point, right, to match long run inflation, right? So maybe like once a year they need to do like another 25 or 50 bips. But basically, like 5 years of oscillating between looser and tighter financial conditions back and forth in 6 to 9 month cycles until the banks are able to roll off the majority of their like hold to maturity losses. And then when the bank balance sheets start to stabilize, you can start to cut rates and inflation should moderate. But that's almost an impossible task, right? Given that, there's an entire global economy outside of that system, right? And the longer we hold rates steady, the more and other banks, smaller banks, central banks cut, right? We get that central bank divergence. They're going to start to push their inflation onto us. So right now we have a big deflationary factor from China. I mean, it's not being realized by the American consumer, but it's being realized by American corporations. And that's kind of offsetting things. But if their economy picks back up and their manufacturing, like overproduction, gets back under control, China prices on Chinese goods are going to start to moderate too, and that's going to push our inflation higher. We still have shipping disruptions in the Panama Canal and the Red Sea. So, that's those price pressures really haven't moderated. The supply chains are fine. Like, we're getting goods where they need to go in a decent amount of time, but the cost of getting those goods to where they need to go is still elevated, and that's also still putting demand on energy, right? Because all of those shipping routes are significantly longer. And so, there's so many outstanding risk factors, right? You have issues with debt in Europe. You have the war in Ukraine. China's shadow banking system, which is wildly questionable as to where it stands, right? And their grossly overestimated GDP figures and youth employment. Um, and in almost all first world countries, you have failing populations, right? And so, that labor demand isn't weakening anywhere. Wage growth hasn't caught up with it, but it'll have to at some point, because people are going to have to fight to get the labor that they need in order to keep running at their peak efficiency and to continue to grow. Right? Everything in this system breaks because it's all built around the long term idea that gains and growth need to be exponential. If we would accept a world where a constant state of moderate growth were acceptable, we would be far better off, and we would have a lot more stability. But we don't want that. Any hope for the Chinese economy? I mean, who really knows? They lie about so much, right? I would say internal competition in China is driving deflation, right? And then that deflation is probably being largely exported to the US right now. But if that overproduction were to slow down, that inflation would end up being held domestically. And this is one of the reasons China's left their rates where they are instead of cutting. They can't lose any more value in the yuan, right? I mean, the yuan's supposed to be pegged at like 713 to the dollar, and it's been trading at like 728 to the dollar for a year. So they're trying not to make any moves until the US makes a move, right? And everyone's in a standoff with each other. The US with Japan, China with the US, EU with the US, right? And ultimately we carry all of the weight of those decisions because we're the number one, we're the global reserve currency, right? So any weakness in any other currency market or any other bond market is just going to bring investors to the US. And it's going to keep the dollar artificially high. If the dollar fell to like 90 right now, our inflation would double. So how do you cut rates, right? I mean, dollars at, like long run, it's very high. Dixie at 105 is quite high. And even at even with the dollar like Dixie at 105, our inflation is still running at like 3.2% year over year increase, right? Which is way above the Fed's target of 2%. And if the dollar were to decline, right, it's going to take more dollars to buy. Our inflation's going to go up even more. So everyone's talking about the Fed cutting rates, but if they do, like, nothing good happens there. I mean, domestically, it's not as bad, but for multinationals, it's a death sentence. Do you plan to dump your 20 years when we get close to the election? I actually sold some recently, like last week, on the drop in yields. If we get another spike in unemployment, I'll get rid of some more. But ultimately, I do expect yields at the back end of the curve to move higher than the rate of real inflation, which nobody's determined yet. If I were in charge, I would have raised U.S. rates to 20% in 2022 and gotten this all over with. We should have just gotten harder and faster. I mean, really where they fucked up is they stopped raising rates because of the bank failures, right? We would have continued to raise rates through to 2023, probably towards like 6.5, 6.75. But the bank failures forced them to stop raising rates because none of the banks can, like, not none of the banks, but over $1 trillion in assets at risk if the 10-year moves above 4.5, right? And if the 10-year moves above 5%, you've got like $3 trillion in hold to maturity securities that are at risk. I mean, like 5%, Bank of America is like 90% of its hold to maturity and ATS risk to their set one capital, right? So it's, what are you gonna do, right? And it's not like U.S. banks are just U.S. banks. These are the largest banks in the world. They have everyone's money. Well, I guess Brian Moynihan won't get a bonus that year. Yeah, he will. The conditions of the stress test weren't that demanding. And survive, I mean, it's not really about surviving. None of them did well on the stress test. Like, it wasn't impressive. It was better when the BTFP was open. There's probably about 280 some odd banks in the US right now, at this moment, with the 10-year at 4.2%, that are at risk of failure and have significant capital demands. If all 280 fail, maybe, just maybe, we can get a red candle. If only Peter Thiel could make that many deposits. Well, we're trying to change how the banking system works, right? We're trying to implement Basel IV conditions on bank deposits, right? But the banks are fighting it tooth and nail, because if they pull back any of their leverage right now, they're gonna become insolvent. So that's why you're gonna see it over the next 2 days with the congressmen and senators complaining about how, because JP Morgan can't leverage another $1 trillion into the market, small businesses around the US are gonna suffer. Sometimes I say paradigm when I probably mean something else, but I'm insecure, so I choose the word that makes me sound smart. If there were a bank run at like a major if there were a bank run at like Bank of America, that would be very, very bad. Nobody can really buy them, right? Like the smaller banks, they can die and they can get absorbed. We can largely handle their failures, and fortunately, that's where most of the CRE exposure is, right? But if there were a failure in any of the GSIBs, it would be catastrophic. No, JPM's actually in their balance sheet's in a good spot. Wells Fargo's a little bit weaker. I mean, that's the problem, right? Is that, the balance sheets at the stable GSIBs like Citi, JPM, they're not weak, but they're not strong enough to absorb any major losses in the financial sector, right? And then, fuck the GSIBs. What about all the private equity, right? What about all the wealth destruction in funds like BlackRock and Vanguard, where exposure is just wildly broad, right? I mean, and they have no leverage conditions. They're not bound by any of those rules. Fuck BlackRock. They stole my house. How? And we have to stop allowing them to leverage the moral hazard, right? We have to, like, we as a country would have to, unanimously kind of be like, no, if you fail, you fail. That's it. Basel IV rules are an international accord. What happens if American markets say, nah, we don't want to be doing that? Yeah, it would make it less attractive to international investors. Of course, there would be more risk in US markets. We would also be breaking, several economic agreements as well in order to back out of that, largely with our biggest economic allies. So it's not desirable. What we don't want to back out of Basel, right? We just don't want to increase bank deposits and create more stability in the banking system. I can only assume it was BlackRock who came in and paid $60K over ask on the house I wanted. They've been mostly like Blackstone, BlackRock, Vanguard. They've been shedding real estate holdings for like a year and a half now. And what we're seeing in Florida, like the Florida real estate market's going to be a really interesting test of how interconnected real estate markets are now due to things like Zillow and Redfin, right?